All right. Thank you so much for inviting me and asking me to discuss this very interesting paper. So this paper is motivated by a very important question in banking and also financial regulation. What is the optimal level of deposit insurance? And usually, as Nishant was highlighting, it's the usual trade-off between bank fragility, access to safe liquidity, and bank moral hazard. And this paper tries to cast a new channel into the light, here talking about how the change in deposit insurance limit basically affects the household's portfolio allocation and then the resulting welfare consequences. So what can we learn about the benefits from deposit insurance in India? So the paper is really based on the idea that households' demand for safe assets exceeds its supply, and therefore the deposit insurance threshold or the limit limits as a constraint basically on how much risk-free assets are available that leads to bunching and forced risk-taking. And the paper exploits really wonderful data around a natural experiment where India increased the deposit insurance limit by 5 in February 2020. And they have used, you can use monthly individual level deposit stocks, mutual funds data, tons of details on household demographics and also location. It defined bunchers as those that are just below the deposit insurance limit. And those bunchers then, after the limit was increased, they increased deposits. And those increase of deposits, a large fraction of that comes from the liquidation of stocks, in particular these state-owned enterprise SOE stocks that were considered more safe because they are basically receiving government guarantees. And so this is a framework, mean variance portfolio choice framework with a kinked capital allocation at the deposit insurance threshold. And in that framework, you can define bunchers again as depositors that are constrained by this deposit insurance limit. And then Nishant really hadn't much time to talk about this, but in the paper actually also talks about how we can use the share of bunchers as a sufficient statistic for extracting depositors' implied probability of bank failure. It's kind of a useful measure. And then they compute welfare gains and argue that those gains are pretty robust to moderate amounts of moral hazard and even larger ones. So what struck me as first is this kind of interesting portfolio choice problem, because typically we think about an investor being constrained and taking on risk. So typically the safe assets, I mean, which is what we teach MBA students, a safe asset is an infinite supply. And so there's maybe a constraint on risk-taking, margin limits, regulatory constraints. And so the investor has to optimize return subject to this risk limit. Here it's very different. Here's a safe asset, it's inelastic, capped by the deposit insurance limit. You cannot be as safe as you want, and then therefore you have a kind of a weird optimization that it has this take into account this kink in the objective function. So the safety-seeking investor is here is rationed, and that leads to forced risk-taking, and then the then basically resulting in a corner solution as a result of the safe asset shortage. So I think this is a fantastic paper. It has really rich data on deposit insurance benefits for households in emerging economy. It's very careful done. It's nearly 150 pages. It's a ton of work, appendix, interesting insights. So let me do comment on 3 things if I have time. The first, the mechanism, really is what we see in the data. This shift out of the SOEs or the equity into deposits. Is this a relaxation really of the safety-seeking investor constraint through the deposit insurance limit? Or is this a flight to safety, given that there was also in 2020, February and March, there was a COVID pandemic also globally. And then, also Nishant said that there's lots of work they've done in the appendix to address external validity, but I think it's really important to discuss the role of the safe asset scarcity across economies. So just think about what we can learn from the elasticities that they are computing here. And then I have some comment then on how actually they can use their method to quantify the value of safety and then address maybe outside of the deposit insurance limit welfare enhancing reforms in India. All right, so just to give you a little bit of more detail on the bunching design. So the setting is again February 2020, India raised the deposit insurance limit. We use a bunching indifference estimator. We compare bunchers just below the thresholds to non-bunchers and then look at their difference, pre and post. That's right, what the interaction captures post the reform. And we have a bunch of depositor fixed effect, zip code, and time fixed effects. And we see the bunchers raised deposits, of which 72% comes from stock liquidation. Now, there's a concern, there's a partial confound that these bunchers may have be scared by the global pandemic and then liquidated their stock portfolios and then put this back into their deposit accounts. And so there's kind of, this is consistent with everything we see in the empirical results, but is a different mechanism, therefore. The paper's defense is they say that the effects begin immediately. Well, immediately it's a monthly data, so it's really hard to kind of tease it out. So pre-lockdown, the lockdown happened in March 2024. And there's clear pre-trends, and they do within households tests, they're looking at a bunch of placebos. But these robustness checks prove internal validity, that the limit binds and the bunching is real. I'm really convinced about it. They do not necessarily establish the causal identification of the trigger. And just to see, it was announced February 1st, February 4th, it got implemented really quick. And February 24th, there was a global stock market crash, and I had no idea what happened in India, but I confirmed that also in India, this was a big concern. And then, so this is still in the same month. So if I'm a risk-averse buncher, because I'm already declaring I care about risk, that's why I'm bunching below the deposit insurance limit. I might be also concerned by the news I see about the global stock market, what's happening with COVID. I might want to rush immediately to liquidate my stock portfolio and then panic selling, and then shows up as an increase in deposit. This is all consistent with empirical results. So as the highly risk-averse agents, the treatment group reacts more strongly to the panic than the control group. Therefore, the estimator might kind of pick up both the policy effect that still might be there, as well as the flight to safety. This is just hard to, given one needs really super granular data, but maybe one could exploit geographic variation, which the authors have in COVID intensity. Green and red zones were also declared, in yellow, I think, also in India, to separate about the severity of COVID, to separate really whether it's about the deposit insurance limit effect from the flight to safety. But generally, could still be argued that, well, since it's a global event and these firms that were potentially large may not be located in a given zone, then they could be affected regardless. So this is just going to be a little tricky to causally separate out. All right, and then a comment on the difference in these two between India and probably arguably many emerging economies. And what I know from. So the paper goes into great detail to show really that insured deposits, and I was kind of surprised, it took me also a while to internalize it, seem to be the only safe liquid assets for Indian households. Government securities were inaccessible before 2021, which is basically they end in 21 February, their sample. Have no money market funds, or they are, but they're very small, and they're also subject to high fees, and there's lots of details in the data. It's really interesting. So typically, when we think about how perceived safety risk is in India, it goes from insured deposits, the risk-free government guarantees. Then there's this thing missing, which is retail government bonds, money market, not available. Then we apparently jump to, as the next best alternative to insured deposits, to state-owned enterprise stocks. They're stocks, so I was surprised that this is the next best alternative, but they're subject to, or they enjoy implicit government guarantee. And then uninsured deposits rank lowest, and that's also, again, surprising, but in India, really uninsured deposits, there's zero recovery, which is realistic in India. And bank failure rates, as Nishant was showing, are actually kind of frequent. So this is very different to the design I'm aware of, in Europe, right? So in the US, There's insured deposits, and then if the constraint binds, the constraint is quite flexible. There's reciprocal deposits, there's fintech services that kind of put your deposits across different banks, and there's even also uninsured deposits that enjoy very high recovery rates. Actually, in the US, it's 95%. Think about Washington Mutual. It was the biggest bank failure up to that point in 2008, 100% recovery in 8 days. This is really amazing. SVB, we talked about this, almost 100% in 18 days. Credit Suisse, again, a lot of these were also then bought by other banks, but this shows that there's other mechanism outside of deposit insurance limit that can provide the safety, and that design around that would also matter for what's the next best alternative in the safe asset. Now, clearly the stocks would rank lowest in terms of what the perceived safety is. So questions for India, so how much will this reallocation channel attenuate if uninsured deposits were actually safer, if there's safe asset alternatives? And this comparison suggests that, again, this deposit insurance limit increase is not the only lever for policymaker. There seems to be a lot of frictions happening that prevent access to safe assets, and that could be a fruitful way forward for policymakers in India. So now also just to kind of close this point, that I would argue that safe assets that households are not constrained in their access to safe assets. US depositors seem less constrained. US depositors have been shifting out of deposits for decades. This is based on Greg Buchek's and Amit Sarou's, my colleagues' work, and their co-authors, showing that this is a long-term trend. This comparison to me raises external validity questions, but there's a tons of related work in the appendix. And then again, there's still interesting to learn about India, so I don't want to diminish this point. It's just that we need to kind of be precise what we are kind of pitching the papers towards. And I think this also just for households is unlikely to benefit in the US. However, for corporate accounts, for corporate depositors, there might be deposit insurance limit increase could be potentially beneficial. Now, in my last almost 3 minutes, so paper discussed welfare and moral hazard, and then argued that the large increase in the failure rate due to moral hazard would be extremely large in order to offset the welfare gains. As I just highlight, this is if the depositor base would change, which is that Ying Ma and Shu Lu and Jane Lee and Carsten Blickle have shown that, so if the depositor base could potentially change, that could increase run risk and fragility because you get the different people into the banking system. Then quite obviously moral hazard affects here in this model only the failure rate that misses a lot of things. I mean, prices could adjust, there's asset quality, there's tons of externality. So what this paper here talks about is welfare from a quite narrow depositor side, abstracts from many economy-wide benefits and costs. However, that's still useful, as Eduardo's work also has shown, if we can then kind of tie these estimates causally to this channel and they're not confounded by COVID. And I think one way of what I think this paper could go, or maybe it's the next paper, is really to use actually the bunching estimates. So this has been done in other work also by Kai-Rong Shao, for example. So this bunching estimator could kind of reveal how much do Indian depositors value safety in general, of deposit insurance in particular, but also in general. So Kai-Rong Shao has done this for regulatory costs. So banks bunch below regulatory limits in terms of asset side to avoid that. So you can back out what's the implied regulatory cost. Here in this paper, you can back out what's the implied value of safety. You could do this outside of the COVID pandemic because that would be just generally true. And then you could kind of get an estimate like how important access to safe assets in India could be and evaluate other reforms from that. So to conclude, it's a very interesting and carefully executed paper with rich data on the benefits of deposit insurance for households in a large emerging economy. I think this is very useful to learn about India, and I feel almost when we want to make the case that it's the same in the US and the estimates are the same, I feel we don't have to go this way because the comparison is limping a little bit. So, but We learned that the threshold constrained households the supply of safe assets to Indian households. We learned that the deposit insurance expansion coincided with equity liquidation that led to deposits. And we learned that India would benefit from financial market reform that provided broader access to cheaper, safe assets. Whether this has to come through deposit insurance limit increase, whether that's the best policy, given that there's moral hazard and other externality that this model doesn't consider, that's an open question. But I think it's a fruitful way forward. So.